Good morning to all of you in Malaysia and good day to those who are in other parts of the world. I'm Ken Pereira and I'm the Managing Director of Hibiscus Petroleum Berhad. Firstly, let me echo the appreciation extended by our Chairman, Encik Zainul Rahim, and thank you for your participation in our 13th Annual General Meeting, which is being live-streamed today. Most significantly, I'm pleased to have the opportunity to present to you an overview of our business performance for the financial year 2023. I hope that it provides you with a reasonable idea of our progress over the past financial year. As is convention, I need to inform you to review this disclaimer as there may be content presented on this slide that could be relevant to you. I also wish to inform each of you that this presentation should be viewed together with our annual report for the financial year 2023 and the relevant disclosures for the quarter ended 30th September 2023. I would like to commence my presentation by covering some macro trends that are impacting our business-related decision-making at the current time. The single most important factor driving the overall performance of our business is oil price movement. During financial year 2023, the Brent oil price benchmark trended lower, dropping from about $110 per barrel to about $75 per barrel. Since the close of our financial year, Brent has advanced to an average price of about $80 to $85 per barrel and seems to be stabilizing at this level. The relative stability of oil prices at this time has resulted in a small uptick in capital expenditure, and the trend of decreasing investment levels in oil and gas projects experienced over the past decade appears to be finally reversing. We have also recently noted the emergence of long-term energy security as a primary theme in discussions around the energy trilemma. There is now a growing acceptance that oil and gas have a long-term role to play in the energy transition agenda. This observation has been underpinned by large-scale M&A transactions being executed, providing a general confidence that this industry has a long-term future. In the first instance, ExxonMobil acquired US-based player Pioneer Natural Resources, a company focused on onshore US shale production for circa $60 billion in stock. Shortly after, Chevron acquired Hess Corporation for $53 billion in stock in another all-American transaction. We view these large sums of capital deployed on oil and gas transactions and the increased levels of funding being committed to our industry for newly sanctioned projects as positive macro signals, signifying a belief that there remains a strong and continued future demand for oil, gas, and their associated products. At the micro level, and focusing on the activities of our company, the slide shows that we continue to be present in geographies in which we understand the legal framework. The key assets of our portfolio are located in Malaysia, in the Malaysia-Vietnam Commercial Arrangement Area, also known as PM3 CAA, in Vietnam, Australia, and the United Kingdom or UK. We will be discussing the performance of each of our producing assets in more detail in just a few minutes, but from a portfolio development perspective, we have seen growth, specifically in the UK. For the Marigold asset, we finalized the Unitization and Unit Operating Agreement, or UUOA, with our partners Ithaca Energy and Caldera Petroleum in September 2023. We are now working towards submitting a Field Development Plan, or FDP, to progress Marigold and our surrounding assets towards first oil production by early 2028. For Teal West, this development is a single well tieback to the Anasuria cluster. It is slated to be put into production in 2025, and currently execution activities are ongoing. Very recently, we farmed into a discovered oil field called Fine, located in close proximity to the Anasuria cluster. The Fine development project is in a preliminary phase and has several regulatory hurdles to cross, but if we are successful, both Fine, together with Teal West, will positively impact our production metrics in the UK and extend the economic longevity of the fields within the Anasuria cluster. Apart from progress on Marigold and Teal West, the group also successfully secured 3 blocks in the 33rd UK offshore licensing rounds. These blocks, located in close proximity of the Marigold development area, will contribute positively to the Marigold and Sunflower developments. It is important to note that our company either operates or jointly operates the majority of assets in our portfolio. This allows us a great deal of flexibility on the phasing of the application of our financial and human resources, ensuring execution risks are managed as far as practicable. Moving on to our next slide. Our ability to be considered as a responsible operator of oil and gas assets, particularly in an offshore environment, depends on our capability to provide a safe, healthy, and secure workplace for our employees and business partners. These are the fundamental requirements of our license to operate. Our HSSE performance metrics for financial year 2023 are captured on this slide. For the financial year under review, we are pleased to report that our company did not suffer any lost time injuries. Whilst this is a good outcome from a HSSE perspective, we cannot allow such historical statistics to make us complacent. In our work, constant vigilance and attention to risk management in all aspects of our operations, particularly in the area of health and safety, are a continuous priority. From an environmental perspective, the metrics presented on this slide indicate that our emission levels are increasing. Whilst this is true on an absolute basis, it should be noted that in early 2022, we completed the acquisition of the Repsol assets located in Malaysia and Vietnam. The associated emissions from the additional production gained through this transaction account for the increase in our metrics. In the following slide, I shall be presenting our response towards reducing our overall emission numbers in the years ahead. Our record of being recognized by regulators, government agencies, and industry bodies, domestically and internationally, is testament to our relentless efforts towards the achievement of strong health and safety performance. We hope to further enhance our health, safety, and environmental initiatives so that our employees and business partners are provided with an even safer workplace, and our regulators remain satisfied with our efforts to reduce our emissions. Given that our carbon footprint has increased on an absolute basis post-completion of our most recent acquisition, it is now imperative that we have and execute a convincing plan to reduce our emissions, particularly our Scope 1 and 2 emissions, in line with the interim targets we have set out as commitments in our net zero agenda. This slide presents some of the specific projects to be implemented in pursuit of our interim net zero targets. These projects will cover reduction of mainly carbon dioxide emissions in the PM3 commercial arrangement area and in the 2011 North Sabah EOR PSC. It is important to note that the identified projects would be also subject to partner and regulator approval. Notwithstanding unforeseen circumstances, the identified projects are forecasted to deliver an estimated 50% reduction in our emissions by the end of the 2030 financial year when compared to the 2020 financial year baseline. We look forward to working with all our stakeholders to deliver these ESG-related targets. To achieve this 50% reduction is not going to be a simple task, but we will pursue it with the hope that this aggressive decarbonisation plan demonstrates our commitment towards operating with environmental considerations very much top of our business agenda. I will now move on and do a review of the operational performance covering the 2023 financial year for the producing assets within our portfolio. I will commence with the assets held under the Peninsula Hibiscus Group. The Peninsula Hibiscus Group assets include the 2012 Kinabalu Oil PSC, the PM3 CAA PSC, PM305 and PM314 PSCs, and the Block 46 Chinook PSC. It should be noted that the Kinabalu and PM3 CAA assets are the largest contributors to the Peninsula Hibiscus Group performance. On a combined basis, the Peninsula Hibiscus Group assets recorded an average uptime of 85%, and over the course of the 2023 financial year, we sold a net 2.28 million barrels of oil and 15.2 billion standard cubic feet of gas. Average unit production cost, or UPC, stood at $13.7 per barrel of oil equivalent. Peninsula Hibiscus Group was also the recipient of several awards both at the Malaysian Upstream Awards Ceremony and further focus recognition awards from various groups of the regulator Petronas. Moving on to the assets held under the Sea Hibiscus Group, that is the 2011 North Sabah Enhanced Oil Recovery or EOR PSC, the fields held under this PSC recorded an average uptime of 94%, and over the course of financial year 2023, we produced 1.72 million and sold a net 1.48 million barrels of oil. Being a mature asset producing mainly oil, average unit production costs stood at $20.1 per barrel. The Sea Hibiscus Group was also the recipient of several awards, firstly recognized by Petronas for operational performance, and secondly, honored by the Chief Government Security Office for demonstrating high commitment towards both safety and security in protecting national interests, and for operating one of only 15 national assets receiving a 5-star award. Once again, we are extremely proud of these achievements. Anasuria Hibiscus UK Limited is our holding company for all our UK North Sea assets. Under Anasuria Hibiscus, we have 2 categories of assets, these being our producing assets and a group of assets which represent our current and future development projects. As far as our producing assets are concerned, these are grouped together under the Anasuria cluster, a group of producing fields acquired from the Shell Group and ExxonMobil in 2016. These fields produce to the Anasuria FPSO, a production facility in which we have a 50% ownership. Our development assets represent our future, and we are pleased to have built a significant portfolio of contingent resources that will stand us in good stead in the years to come. Operationally, the Anasuria cluster demonstrated an average uptime of 85% over the course of financial year 2023. During this period, we sold a net of 730,000 barrels of oil and 612 million standard cubic feet of gas. Being a mature asset producing to a floating production facility located in the UK North Sea, we are pleased that our average unit production cost stood at $22.8 per barrel of oil equivalent. Anasuria Hibiscus was also the recipient of several awards, firstly recognized by the Royal Society for the Prevention of Accidents, or ROSPA for short. From ROSPA, we received a Gold Award for calendar year 2022 Health and Safety Performance at the Anasuria FPSO. In addition, we were honored to receive an Order of Distinction, being recognized by ROSPA for 24 consecutive Gold Awards. On 6 October 2023, the Anasuria FPSO also celebrated 8 years without a lost time incident, a record that we are tremendously proud of. I would now like to provide a brief review of our financial performance for the 2023 financial year. Over the course of the 2023 financial year, supported by sales of 7.1 million barrels of oil equivalent of oil, condensate and gas, the group recorded a consolidated revenue of approximately 2.3 billion ringgit. Of this amount, more than 1.3 billion ringgit of turnover was delivered by Peninsula Hibiscus Group, whilst Sea Hibiscus and Anasuria Hibiscus recorded revenues of 627 million and 347 million ringgit respectively. From an EBITDA perspective, we delivered more than 1.2 billion ringgit, whilst 2023 financial year group profit after tax stood in excess of 400 million ringgit. Our UK asset segment, held under Anasuria Hibiscus, showed a loss after tax of 23 million ringgit. It should be noted that profit before tax stood at 137 million ringgit, but an adjustment to the taxation line item of our profit and loss statement, attributable to non-cash deferred tax effects, an outcome of the imposition of the UK Energy Profits Levy on our business, caused Anasuria Hibiscus to report an after-tax loss for the year. From the bar charts presented, we believe that our key financial metrics are showing positive trends, even though we operate in a volatile business environment. We also managed to deliver on the prior guidance disclosed for dividends. Subject to your approval today, we would have declared an aggregate of 6.25 cents per share for the 2023 financial year, this being the dividend declared after the relevant adjustments as a result of the share consolidation exercise of October 2023. As you will also be able to see from the chart on this slide, since we commenced declaring dividends, our payouts have been on an increasing trend, rising from 3.75 cents per consolidated share in financial year 2021 to 6.25 cents per consolidated share in the 2023 financial year. For the record, our dividend guidance for financial year 2024 stands at 7.5 cents per consolidated share, subject to favorable market conditions. On the whole, we are pleased with our financial results, and we believe that our strengthening balance sheet will allow us to grow the company further. Just over 2 weeks ago, we announced our first quarter results for financial year 2024. Our numbers continue to demonstrate trends seen in financial year 2023. A strong operational performance was delivered, with about 2 million barrels of oil equivalent sold on the back of an average daily production volume in excess of 20,000 barrels of oil equivalent per day. We delivered an EBITDA of 393 million ringgit and a profit after tax of 154 million ringgit. We also provided forward guidance for the 2024 financial year, informing our shareholders that we target to deliver between 7.5 and 7.8 million barrels of oil equivalent, up from 7.1 million barrels of oil equivalent delivered in financial year 2023. Again, we believe that the strong start to the 2024 financial year provides a sound platform for the year ahead. This chart presents the projected growth in our production volumes over the next 2 calendar years. To arrest the decline normally associated with midlife assets and grow production, we expect to spend $232 million and $177 million in capital expenditure across our asset base in financial year 2024 and financial year 2025, respectively. In addition, we will continue with some infrastructure-led exploration drilling and prospect for relevant acquisition opportunities as growth levers for our business. It is important to note that we remain committed towards achieving our objective of securing between 35,000 and 50,000 barrels of oil equivalent per day of net production by the end of 2026. In the conduct of our day-to-day operations and in pursuit of our business objectives, we engage with our business partners, regulators, and the multiple players that make up a sophisticated international supply chain. We have featured the identities of some of these parties on this slide. To all of you who work with us and to the communities that are located around the areas where we are present, we wish to express our sincere appreciation and thank you for your support. A special word of thanks also goes to all the analysts who cover our stock. Our business takes a great deal of understanding, both from a technical and economic perspective. Thank you to all of you for taking the time to understand our activities and for your continued coverage and interest. Our shareholders most definitely benefit from your work, and on behalf of all of them, we would like to express our sincere thanks to all of you for the work that you do that eventually enhances understanding and better informs our shareholders of our business. As we reflect on the past year, we note the reality is that we must plan for an energy transition to a more carbon-friendly energy mix. Such plans, based on a sustainable business model, are being developed and will be announced in due course. In the interim, we will focus on our aggressive decarbonisation goals. Apart from the operational awards that we have already presented in the previous slides, we were also honoured with the prestigious Asia Money Award for the Malaysian energy sector and the Edge ESG Silver Award for energy transition. In both cases, our selection as a recipient of these awards was subject to robust third-party assessment, and we are extremely grateful for having been recognized for our performance both from a financial and ESG perspective. Finally, on behalf of the board and management of the company, I would like to express my sincere thanks to all our shareholders. Many of you have been invested in the group since our listing, whilst we have also, in recent months, welcomed some reputable names onto our share register. To all of you, thank you for your trust and loyalty and for all the interest you show in our company through your daily trades on Bursa Malaysia, your attendance at our quarterly briefings, annual meetings, and investor calls. Thank you very much.